Hello, Mark. Welcome to Options Brew TV, our traders workshop. And we are live from New York today, right? You're in Manhattan?
I'm actually in Brooklyn, New York, but we are live from New York. It is Thursday at noon.
Awesome. Well, welcome. Iron Condor today, right? Yeah, and maybe using it for some income generation. I think Iron Condors are very popular in the retail world. You know, one of the reasons I think that I hear from some of the retail folks we deal with, all the units are covered, right? We can make a credit spread on the put side. We can make a credit spread on the call side. Seems like everyone's happy with credits, no exposed units, et cetera. So I'm sure we'll get into that. But let's go to it. What do you say?
Yeah, that sounds great.
Okay.
I think sort of like you said, we're using this as another type of income generation tool, right? We've talked about covered calls. Are there one way to, generate income from holdings? And actually with an Iron Condor, you don't necessarily even need to own the stock. You can do this on stocks that you don't necessarily own.
Right.
They're a good, sort of orthogonal income generation tool that you can add to the portfolio to either layer on, an overlay on something that you already have, or, look to other names that might be higher vol and you kind of want to capture that premium, but capture that premium exactly like you said, in a defined risk way.
Perfect. Okay. Let's have a look.
I will pull up my trade hawk right here.
Okay.
So
let me give you a plug. Don't forget, everybody, Mark is from Harvested Financial. I like to call Mark the guru. He's kind of, the options guru guy, man. I love talking to him about options and wine.
So it looks like you're looking at the Oct 15th expiration here, right? About 22
is
days out.
Is that the one you wanted to do?
I do like the Oct 15, and kind of for two reasons. One, the duration, that sort of 20 to 30 days. I like kind of keeping these types of things on a monthly cycle.
Okay.
It's not exactly scientific, but the idea that you get sort of a certain number of days to see something shake out. You try and do a strategy like this on too short of a duration, you're kind of going to get chopped up. You go out too long of a duration and you're going to, not really collect as much income. And so somewhere in that 3, 4, 5 week time frame tends to be a sweet spot for these type of income generation strategies. So I like Oct 15th for that reason. And then sort of a secondary reason is Oct 15th is the serial expiration, which means it's the monthly expiration. Every option has options expiring on Oct 15th. As you can see, SPY has many more expirations,
right?
But liquidity always tends to pool in these serial expirations.
Right.
So that's really important for getting into the trade. And it's also really important for getting out of the trade. That can save you pennies, and those pennies become dollars, and that really adds up. So, getting on a cycle where you are focusing on those serial expirations, it's just another good way to ensure you are getting the kind of best execution and price possible.
Right. And just as an FYI, when you refer to serial expiration in the days when we traded, or at least when I traded, you're not as old as I am. We didn't really have weeklies. Those were introduced later. So that weekly concept came in after a while, and expirations were what you refer to as serial. And it was the Saturday after the third Friday of the month is how they were. So we still have them, but now we've just littered everything with weekly, so you can trade your head off 1 day, 4 days, on end, right?
Exactly. And like you said, the weeklies are a relatively recent advent. And, even more recently, I believe it's SPY and QQQ, SPY first and more recently QQQ, now have these Monday and Wednesday expirations placed in there too. So you literally always have an option that's 1, 2, 3 days out.
Right. Okay, let's set this up. I have it set up already. I made screen big. I can go back and forth. So I just wanted them to see the strikes all together. So the Iron Condor, first of all, just give us a flavor. What does it look like? What's the components of it?
Yeah, so the idea with this trade is to, like we sort of mentioned at the beginning, is to capture that volatility premium. You want to end up with a credit, but you want to do it in a defined risk kind of way. And so what the Iron Condor looks like is you're setting up selling a call spread and selling a put spread. And both of those should generate, or not should, they do generate positive premium. But in this case, only one of them could land in the money. At come expiration, stock's either up or down. So at worst, only your loss is going to be limited to the difference between the two strikes on one side minus the credit that you received to put on the trade.
Got it.
So you sell an upside call spread and a downside put spread. If stock goes down below your long strike on the put side, the most you could lose is the difference between those put strikes. Same with on the minus the credit you receive. Same with on the call side. If it goes above that long strike that you have on the upside, that would be your max loss scenario to the upside.
Right. And that's, oops, sorry. I'm making all kinds of weird. So that's above here on the call side. So if it goes above the 456, the spread will go to its full $5 again at expiration. This one will be worthless. So it's essentially as you said, the difference between the strike up to the upside, less your credit, and the downside the same way. The only reason I say it that way and the way you said it is because it's important to note these don't have to be uniform, the differences between both sides of the strikes. There's no rule that says it has to be that way, but it does change your risk parameters if you choose different strike widths, correct?
Correct. And I think that's a great way to start adding some nuance to your trade here, right? Especially when you look at the granularity of strikes that you have in SPY, a product like this, you can get really tailored and say, have a 5-point spread on the downside versus a 2-point spread on the upside.
Right.
Or maybe, you want a longer one on the upside to give yourself even more of a credit and you're willing to take that risk.
Sure.
So, the structure of this trade really provides a lot of different points of flexibility.
Yep. Understood. Okay. So I have it set up $5 put spread on the downside, $5 call spread on this upside. And I know that you mentioned to me that you have this this propensity to choose about the 30 delta call and about the 30 delta put for the placement of your short strike. Does that sound accurate?
Yeah, exactly. And I think, we talked about how the difference between the legs of either the call or put spread adjust your sort of both risk and premium capture.
Mm-hmm.
The distance that your short leg is from the at the money is going to be another factor there. And so that's that 30 delta that you're talking about. So the tighter those are into the money, at the extreme, if you sell the at the money, you end up with a position that looks like a butterfly.
Sure.
But the further you pull apart those butterfly kind of legs, the lower premium you're going to collect. You sell very far out of the money, put spread or call spread, those aren't going to be worth a lot.
Right.
But it's trying to find that balance of premium collection versus risk. And that 30 delta, it's a good rule of thumb across a lot of different strategies. I use a very similar sort of heuristic in buy writing, covered calls. Okay,
good. And here's just a risk profile of this trade, right? And I guess I could do it all kinds of ways, but this is, what do you think? $20? That's about right. That's good enough, right? For spiders. So you get a good flavor of what this looks like. Okay. And this is at expiration on October 15th, 16th, whenever we said it was. And you could see the range through here where your max profit lies, right? And there's going to be some magic to what that all represents relative to our short strikes and long strikes. And then we have our max downside loss and our max upside loss, which we just said is the difference between those strikes, less your credit that you're doing. Because this is a uniform spread, it's going to look uniform on both sides in terms of the loss and profit side, right?
Yep. And I think we set this one up with $5 spreads.
Yep.
$5 leg lengths of those call and put spreads, and that really depends on your risk tolerance on the actual name itself. Sometimes $5 is going to be too tight, sometimes it's going to be too wide. But you really want to look at kind of your directional bias here and what overall vol levels are to help sort of inform the distance of those spreads.
Mm-hmm. Great. Yeah. So this is a fairly limited risk reward kind of deal, right? I mean, there's great spread for generating this kind of some income. I think safe, right? We're risking about 1-to-1 here, more or less. Is that right? Yeah, about a little more, but not too bad.
Yeah, but I think an interesting way to think about that is, okay, so we're collecting about $2.11 on this trade. We do this trade, and the max loss I can have, or that you can have, is that $5 vertical minus that $2.11. Mm-hmm. So your $2.11 versus your $2.88. So, that's, call it a little more than 40%. Right. But you're selling the 30 delta legs on either side. So one way to think about that delta is to say that that's a 30% probability of that option landing in the money at expiration. And so if your odds that you're collecting are about 42% compared to 30% probability of it being over that strike, that starts to look interesting. That's kind of back of the envelope math. I realize it's a lot more complicated than that. And, you need to think about the distributions of, the returns at the extremes, but that's also the benefit of having that sort of capped risk in place.
Yep.
So collecting $2 with a 30% chance of it going up or down, that seems like a pretty interesting risk reward here.
Yep. Understood. Yeah, no, that's good. Any thoughts? We'll close after this, but any thoughts on adjusting this if needed, or rolling it when the time is right? How do you look at that? Clearly we can have a breach of a short strike, right? What I mean by that is if the stock starts moving down toward your short on the put side, let's say, pre-expiration, you could start getting long some deltas potentially, and all of a sudden your spread doesn't look so good. Do you do anything, or do you let it go? What's any thoughts there?
Yeah, it's tough. With all premium collection strategies, a lot of that value realizes itself towards the very end. So as you can sort of see with some of these curved lines here, the way that spread will behave over time, you can see that really, no matter where the stock moves in some of those early days, that the full value actually doesn't really realize itself until the end, because there is still time for that sort of variance to take place. So, it's a dicey game thinking about these. But one thing that is interesting, I think sometimes, is potentially if we see a big rally, maybe you roll up your put spreads. That tends to be a good opportunity to pull up your put spreads. Or on the other side, you can bring in your call spreads. And, if we're leaning down, if markets dropped off, you can tighten up your call spread, collect a little bit of extra income to offset that.
Sure. Exactly right. So, and all that means, in terms of this is, let's see if I can get there. So if what Mark's saying too is if the stock starts heading down toward this one, you're saying you could roll this put short, and this, I actually say the spread, you could roll the spread down a little bit, gain a little bit more premium. So essentially you're closing this out for whatever the debit's going to be, creating a new credit spread, rolling it down, kind of recentering in a way, right?
Exactly. And you have captured some premium on that call spread, because if the stock's going down, that call spread is going to be worth less. You're short it, you're going to be able to buy it back for less than you sold it for. So you are going to collect a little bit there. You're going to sell the closer to the money call spread for a greater premium. So you're going to, again, collect more income. All that sounds great, but you got to remember, you're also exposing yourself to upside risk at a lower price point.
That's right.
So
you get chopped up, in other words, right? I mean, which I was really good at times, chopping myself up.
Exactly. This is a short gamma kind of strategy, right? That, you got to really play that balance of catching the move or trying not to catch the move because it's coming back.
Right. Good. Okay. I love it. Awesome, Mark. I'm a big fan of the Iron Condor. I got to be honest. I really like that one.
This is another one of those, very much like the covered call, that it's a relatively simple trade. Like I mentioned, you don't necessarily even need the stock to do this. You can actually do this in relatively small accounts. Even in names that you might not be able to afford 100 shares of, right?
Sure.
You can do Iron Condors on SPY for a lot less capital. In this case, you need the max difference between those spreads.
Yep.
So very accessible strategy, really interesting to generate income, and a lot of different levers and knobs to turn in terms of adjusting your risk tolerance, whether that's your distance from at the money, the length of your legs, all kinds of fun things you can do with this. So super flexible, super powerful strategy here.
Yeah, good. Okay, love it. Great. Well, thanks, Mark. That's awesome. You have a great rest of the week, and we'll see you next week.
Yeah, enjoy your weekend, Lex.
Okay, bye now.